the movement going from now? Is it still a downward trajectory?
So the two key drivers, demand and supply. So demand has been softer for steel in China, but during that period of softer steel demand during the COVID shutdowns during April, May, steelmakers kept making steel. So steel production numbers were actually very high. In fact, April and May were the fourth and fifth highest month steel production ever in China. So a lot of steel stock was built and put into inventory. That's come out into a period now where growth is starting to pick up, but inventory is still exceeding demand, so prices are softer because of that. Steelmakers are also sitting on price inventory, can't sell product, and they're achieving gains or margins which are very low, if not zero. That's the demand side. On the supply side, the June quarter is seasonally the strongest quarter in the year for Southern Hemisphere supply of iron ore to Asia. That's out of South Africa, out of Brazil, and also out of Australia. And about 28% of the annual supply of iron ore goes in this one quarter alone. Now, allowing for delays in shipments that take anywhere between 4 and 6 weeks from Brazil or Australia to China, that means these shipments are still on the water in some cases, and they won't hit China for another 2, 3 or 4 weeks. So this stronger supply quarter is still yet to be present in prices. So the pullback we've seen is partly showing that. And going forward, we should see more supply coming through in the next couple of weeks. So you've got that weaker demand, stronger supply, inventories high at the stock level for steelmakers, margins low to non-existent. And that's not a recipe for higher prices for either steel or iron ore. Steel prices do set the tone for iron ore prices, and they've been tracking lower in the last couple of weeks. So right now, looking at the second half, short of very strong stimulus and that feeding through to demand for steel products, the iron ore market looks weak in the second half.
It certainly doesn't look a particularly promising prognosis from here, Peter. What about trading opportunities from all of that? How would you see that?
Well, the fascinating thing is iron ore equities are finally starting to catch the same headwind as the iron ore price has, and they're starting to retreat, which is meaning there's starting to be a little bit more headroom in iron ore equities. So every iron ore company that I cover in my universe is now trading at a discount to its fair value. That's the first time in almost 2 years that has been the case. Going back to the first Brazil dam incident in 2019, the stimulus coming out of COVID in 2020, iron ore equities have enjoyed a great tailwind over that period of time. Today I can buy Fortescue, I can buy Deterra, I can buy Mount Gibson, the Canadian iron ore companies, all at a discount to fair value. That's a proposition which is starting to catch my interest and pique my attention going forward. Not quite cheap enough yet, given that second half backdrop. They're certainly better than they were. So instead of trading at 1.2, 1.4, 1.5 times fair value, now at a discount. So the ones I'm most looking at, BHP and Rio Tinto, because they're diversified. So they offer you a little bit more than just iron ore, particularly if there's iron ore headwinds in the second half. So a little bit more value, but still probably a little bit early to look at iron ore equities. I'd still be fading the iron ore names into this sell-off.